Good day, everyone. My name is Rebecca Lilly for the International Association of Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Dutch Disease in Norway. We are grateful to our speakers, Knut Inten-Mork, Hilda Bjornlund, and Klaus Mohn for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services that you can find at our website, www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speakers. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for the panelists, please click the Q&A button at the bottom of the Zoom window and type your question. We've allocated time at the end of the webinar to read and answer them. And now I would like to introduce you to our first speaker. Hilda Bjornlund is a provost for research and academic resources and professor of economics at the BI Norwegian Business School. Hilda, over to you.
Thank you, Rebecca. It's a great pleasure to be here and to be talking today. So let me just try to share my screen. You should see it.
Yes, you could go
yes.
Full screen.
Good.
Perfect.
All right, so thank you. So this is it's a great topic, obviously, from both from an academic perspective and also us who have been working in the Norwegian environment for some time. But I believe this is of a great interest for a much wider audience. So it's great to be here. So I'm going to be basically talking, my talk is going to be based on 2 papers in particular. One which I have with Stefanus Thorsrud, Boom and Glue, examining the Dutch disease in 2 speed economies from Economic Journal. And the second one, which is also with Thorsrud, but also Ragnar Torvik, Dutch Disease Dynamics Reconsidered from European Economic Review. In addition, I will be using some slides at the end from OECD and the Minister of Finance. All right. So the big question is obviously, is oil a blessing or a curse, the oil windfall? So going back to like Sachs and Warner 1995 paper, they typically showed using panel data in a regression that there's a negative relationship between growth in resource-rich economies and the resource export as a share of GDP. So on the horizontal axis, the more resource export you were having, the lower would be the growth rates. So it was a relationship here which was negative. So finding oil or gas, for that sake, was negative for the growth. Okay, so that's a finding that's been around for some time. And then the question is obviously, does it fit the fact for all the countries? So before going down that lane, let me talk a little bit about the Dutch disease, which is part of this story. So the issue is really whether resource booms enhance growth in a country or lead to a crowding out of other tradable industries, such as manufacturing. And in the traditional Dutch disease theories, then the crowding out effect would typically be dominate, and the idea would be that large gains from the booms which you had, which the oil boom, oil sector, but also the other sectors servicing this industry would be dominant, while the rest of the country would suffer from adverse effect because of higher wages in the profitable oil sector and surrounding industry, an appreciated exchange rate, and then a lack of competitiveness as a result of this. So the other tradable sectors would then be suffering. In the more modern, if I could put it, modern Dutch disease theories, there was also an element of learning by doing, which could make things even worse, I would say. Because there it was, the idea would be that labor would move from sectors with strong learning by doing to a sector with weak learning by doing, and thereby push growth down. So the assumption is that all this learning is in manufacturing, and because manufacturing is hurt by the oil sector, there wouldn't be any learning, so thereby growth would be moving down. But as I said, does it fit the facts? So from Norway discovered oil in 1969, GDP per capita has grown by around 65. It's gone from 65% of Sweden to 150% of today. So Norway's obviously been quite rich, and economists had a wonderful piece about the Nordic country where we were the rich cousin in the north. Whether that's good or bad, I don't know, but at least that was the idea. But the big question is what's happening to labor and productivity. If you look at this graph, on the left hand, we have a share of employment in tradable sector, comparing Norway to Sweden. And on the right hand, we have productivity, labor productivity, comparing Norway total, Norway mainland, and also with Sweden. So if you looked at the left graph, it seems that in all countries, employment in the tradable sector, in manufacturing sector, has declined due to outsourcing to, for instance, China, etc. But it seems clear that employment in the tradable sector in Norway has fallen more than in other countries, which could be a consequence of the Dutch disease. So looking at the left graph, it seems that at least this Dutch disease theory holds somewhat for Norway, that there has been some crowding out. But looking at the right side, it doesn't really fit the fact, because labor productivity has increased immensely in Norway. In total, the dark black, but also in the staple, the line for the mainland economy, and relative to Sweden. And why Sweden, you might think? Well, Sweden, very similar country, small open economy, but an oil importer versus Norway being an oil exporter. So there's some issues here which tells us that theory doesn't really fit the fact for Norway. So what's the issue here? So there's 2 points I will make, which relates to the 2 different papers. So one is really the fact that in this traditional model, there's no spillover effects from oil to the back to the economy. So it's like finding oil is really about putting a straw in the North Sea, sucking up oil and giving it to the government. There's no spillovers in this process, no learning, and no technological spillovers. So Norway has gone really from what we would say is a passive recipient of windfall gains to an exporter of technical knowledge. And that's really the key of what I want to say, that Norway is that to find oil and gas is technological challenges, and that process itself to develop it has spillovers to other industries. So in the paper I have with Torsrud from 2016, we show that these studies of Dutch disease cannot account for productivity spillovers between these booming resource sectors and other non-resource sectors. So for instance, in Norway, it's an oil service industry, which is also servicing serving the oil, but it also has spillover to other manufacturing. So we put forward a simple theory model which allows for these spillovers. And then we quantify them empirically, allowing for both these resource and spending effects using a large panel of variables. And I will not go into detail in the model. You can read the paper if you're interested. But what we found is that, and we do this, we compare Norway with Australia, another resource-rich economy, which has commodities, but not that much oil and gas, but has other commodities. And what we found, looking at impulse responses, is that an effect of an increase in oil activity, investment and value added, has a positive effect on GDP in Norway, and also similar in Australia, but much larger in Norway. So the black solid line is impulse responses. So for 1% increase in petroleum activity, 0.2 in the mainland economy GDP. And the effect remains for 4 to 5 years. These are quarters on the horizontal axis. But we also show that there are significant effects for productivity. That's in the middle frame for Norway. And we also see that there's a huge positive effect on employment in non-oil industry. So this is non-oil being affected by a resource boom due to investment, spillovers, etc. We also show, so this is the aggregate effect. We also show, and here I show it for Norway, disaggregate effects into manufacturing and other industries in Norway. So like a 1% increase in these activities would have effect on value added and employment in many industries outside oil and gas, like construction, business, hotel and food, industries which service the oil and gas sector, but also are benefiting from technological investment, etc. So we find positive spillovers, which explain why the theory didn't find the facts. So what about learning? So why did the theories of the learning by doing and Dutch disease run ashore? And the main takeaway point here is that the productivity dynamics, which were originally in this model, referred only to the spending effect, but there was no productivity dynamics or spillover for that fact for the resource movement effect, the fact that resources were moving between the industries. And here in particular, the oil service industry, industries related to oil, but not oil directly themselves, could be an engine for growth. And there were no model in the literature which incorporates this productivity dynamics. So what we did in the second paper is that we developed a 3-sector model relative to 2-sector model, where the third sector was the industry, which had which was servicing the oil and gas, and then we allowed for productivity dynamics from both spending and resource movement effect, consistent with the empirical findings you've seen already. And to make things a little bit more well, challenging for us, but in terms of realistic, we separated between oil activity shocks, i.e. finding oil, and oil price shocks, i.e. becoming richer because oil prices increased. And then we looked at theoretically and empirically. And what we found in this model confirmed previous work, but also gave us new ideas. So here what we have is a graph which shows the effect of an oil activity shock, dark gray, and an oil price shocks, light gray, on all sectors in Norway, traded sector in the middle and non-traded sector. And the bars, the boxes are the interquartile range across sectors. So the vertical lines is the median, and this dotted lines are outliers. So you would have like outliers around there. So basically what you see is that oil activity shocks, i.e. the finding, discovering, exploring, investing, that has a positive effect on all industries, but in particular on traded sectors. So that's we see from the dark gray. So these are effects 3 years after activity has started. Whereas the light gray shows that higher oil prices has no productivity effect on the different sectors. So the fact that oil prices go up is not really good for productivity, but doing activity in the oil sector is clearly good. All right, so that's this is fully in line with the theory model, and this is the empirical finding from the sectors in Norway. So conclusion so far, Norway has, at least from this analysis, which is in the period up to 2 years ago, Norway has so far escaped the Dutch disease, and we stand out in that way relative to many oil-producing countries, according to these findings. And we do find that there is increased productivity in many sectors, whereas higher oil prices is not particularly good for this. But there is a but, and the but comes with challenging ahead. And I'm just going to show you a few slides. Unfortunately, these are in Norwegian, but the graphs, because these are from the Ministry of Finance and I didn't have an English translation, but I explain very quickly what it is. This is really, so we have saved a lot for the rainy days. A lot of the income has been moved to the oil fund, and we have a spending rule. The red one is the spending rule. We spend 3% of the oil fund going forward. That's the plan. And the bars here are what we have, the phasing in of oil income into the Norwegian economy as a percentage of GDP. So, for instance, if you take the last bar in 2021, it says that 9%, the structural oil-corrected budget deficit is 9% of GDP. That's what we are facing into the economy going forward. And if you see from the red, we are planning to spend a little bit more, but then it will phase down as there will be less income to the oil fund, and we have to spend more. as the economy is growing. The issue here is that we have become quite used to increased spending on a large scale historically, but going forward, spending will not increase in that amount. And the problem is then that we have become quite resource use in public sector in Norway has become quite large relative to OECD. So on the left, public expenses as a share of GDP is the highest in Norway relative to other OECD countries. And number of employed in public sector, that's to the right, in Norway, top again the scale relative to other OECD countries. So although we have saved a lot, we have sheltered the economy, saved for the rainy day, we still have, obviously, because of all this phasing in, allowed ourselves to build a welfare state, which has a sizable share of public sector relative to GDP. And while that might be good idea, it's challenging going forward when we have to where we have less money to phase in. So that's why, and the second challenge, which is the final thing I'll say, in this process, we have also managed to, so although we have a large share of the population working, we also have a larger share than comparable countries outside the labor force, being disabled. So the share of disabled on the left and persons under 30 years disabled on the right. And on the left, if you compare Norway, the black bar going up, whereas in other Nordic countries, either going down or being flat. It seems that we have a larger share of people outside the labor force in Norway, and we also have a lot of young people being disabled or on other benefits. And that has made the OECD, for instance, call out that we might have some challenges going forward with regard to labor force and with regard to a large public sector. So that was my quick 15 minutes. We have so far escaped the Dutch disease. We stand out relative to many oil-producing countries. We have saved a lot for rainy days, which will come very useful going forward. But there are challenges ahead for the Norwegian economy. In particular, the resource use in public sector is high, and the number outside the labor force has increased and is relatively high in the OECD, which makes it challenging. Okay, so that's all for me. Thank you. Let me stop sharing. And by that, I will give the word to the next speaker, Knut Anton Mork, Professor Emeritus from Norwegian Business School and from NTNU. The floor is yours.
Thank you, Hilde. I'm going to ask the same question all over again. Is there Dutch disease in Norway? This is based on an article published earlier this year in the Energy Journal with a slightly longer title, namely The Long Norwegian Boom, Dutch Disease After All, ? And now we're having a slight technical issue here, so I'll have to have Rebecca change my slides for me. And here's the first one. Thank you, Rebecca. I start with, well, somewhat stronger language than Hilde and call it a myth that Norway has avoided the Dutch disease. Yes, it's true. The tax system is designed so as to collect essentially all the resource rent from the oil companies and channel it to the government, put it in the oil fund, or with a much longer official name, Government Pension Fund Global, although it has nothing to do with pension obligations, but that's a name. But the intention there is very clear and very noble, namely to separate the spending of these revenues from their earnings, separate them in time, so that we don't get this peak of spending, this spending shock, that in many ways is the origin of the idea about the Dutch disease, so named after the experience in parts of the Netherlands in the 1960s during their natural gas boom. But according to this plan, there is no wealth shock in the private sector, not really in the public sector either, because it's all being salted away. and just taken out as a presumably sustainable share, the average real return on the fund to be spent in the budget every year. That's now becoming big money, as Hilde told us, but still a very small, essentially a 3% part, 3% share of the fund. So everything is supposed to be smooth, and because of that, there would be no reason for any loss of productivity. Okay, so now what about the facts? Rebecca? Yes. A fact, I'm going to get back to Hilde's point about productivity, and let me emphasize, I have no disagreement with Hilde about her findings. I'm just looking at something else. An important fact, which also Hilde alluded to, is that we've had a long boom in the Norwegian economy since the turn of the century. Okay, so it's been interrupted by a global recession, shallow global recession at the beginning of the century, then the global financial crisis, and then we had the pandemic. Yes, okay, but by and large, looking through all that, we've had a tremendous boom. The government has become rich. Okay, that was intended to be the result, but so has also the private sector. Okay, did they become more productive? Yeah, Hilde says a little bit, or rather, productivity has grown like in our neighboring countries, and I'll get a little bit back to the details of that. But mainly, my claim is not that was not the major force behind building this wealth. It's rather relative prices that were driven upward and created real incomes that had nothing to do with productivity. Furthermore, the rent that was all supposed to go to the government has in fact leaked out to the private sector. That is what I call this wealth increase in the private sector. And then I ask the question, is this Dutch disease after all? Rebecca? Numbers. I've also looked at GDP figures, and I compare Sweden and Norway. Why Sweden? Okay, Hilde did it too, so then I suppose it's okay. But rather, referees are good to have when it comes to these things. And they asked me to look at other alternatives, such as synthetic and counterfactual, based on an average of a number of relevant countries, comparable countries, according to certain criteria. And I looked at that, and if I did that, I would actually get even more dramatic results. So I give you these, which are at least very appealing. And after all, Norway and Sweden, next door neighbors, very much alike in very many ways, with one big exception. We have oil and gas, they don't. Okay, this graph is in units that are a little different from what we're used to. So let me pause a little to explain that. They are all in nominal prices, current prices. Okay, does that have meaning? Yes, it does if we translate them to the same currency. So that we, for example, take Sweden's GDP in Norwegian kroner at the market exchange rate, do both in per capita terms, and then compare them. So we're ending up here not with an absolute price, but with a relative price, and that's what matters. So we have Norway as a percent of Sweden. That is per capita GDP in the same currency, Norway as a percent of Sweden. And let me add, this is not Norway including the oil companies, the oil sector in a narrow sense, because if I did that, it would be much larger, but that's not really produced GDP, that's resource extraction, and that's something else. So I narrowed this down to mainland Norway, which is a Norwegian nomenclature for non-oil Norway, really. That is not the oil companies, but everybody delivering goods and services to the oil companies are in there in the blue curve. And moreover, I take in that entire non-oil economy, not limited to the exporting sectors, and that's the difference from Hilde's numbers. And when I do that, I find that if we had done this in fixed prices, then Norway and Sweden would have developed more or less exactly the same during these 2 decades. So quantity is pretty much the same. That's not bad at all. Swedish economy did marvelously well during this period, and so did Norwegian. But the incomes resulting from it were way higher in Norway, almost 40% at the peak, then coming down a little bit towards the end of the decade. Rebecca? Thank you. We can look at relative wages the same way. And again, I'm looking at the entire non-oil economy. And they're a little different from Hilde's numbers. Productivity is not doing any better in Norway than in Sweden. But again, essentially exactly the same. But wages are way higher. Essentially the same distance between wages and productivity as we saw between nominal and real GDP development. So, yeah, let me look at one more thing of what happened, or the facts here. Rebecca? Yes, the resource rent. This is a very, very rough calculation. I tried to calculate the resource rent per year per capita in Norway during the 20 years 2000 to 2019, calculated in 2019 US dollars. The government got this out of this from the tax system, defined as the net petroleum cash flow, $7,600 per capita. But in addition to that, the Norwegian economy grew in value about Sweden's $10,300 per capita instead. Add it up and look at what comes where. More than half to the private sector. Now, I repeat, this is an extremely rough calculation, so I wouldn't attach any significance to the details here. However, the very fact that as much as half has leaked out to the private sector is remarkable. Okay, wasn't there intended to be some private benefit? Yes, out of the fiscal rule, this 3% spending on the fund. Yes, but a much lower number, 3,100, just a third what the private sector apparently got. So, Rebecca, let's look at what happened. How can I explain this? The first thing that happened was a petroleum investment boom. And interestingly, it happened after production peaked around the turn of the century. And you may ask why, how could that be? Don't investment and production, aren't they connected? Yes, they are, but typically the low-hanging fruits are taken first. And the fields that were developed during this period required much more investment. And so you had this delayed reaction, if you like, in the investment activity. So you got this peak in oil and gas investment. That's the one point. First point, and Rebecca, the second point. Oil company home bias. Oil companies, when they invest, need to buy stuff. They buy lots of goods, equipment, rigs, cables, whatever you have, and services. Seismic services, financial services, legal services, blah, 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 etc., etc. And essentially all of these purchases were purchased from Norwegian actors. Not all Norwegian-owned companies. There were subsidiaries of international companies by all means, but it all took place on Norwegian soil, essentially. Why the home bias? Well, in the very early phase in the 1970s, there was an official protection, but the home bias persisted even after the rules were liberalized in the 1980s. But Norway was lucky, I presume, because we were already a developed economy, having a stable democracy and having all the institutions in place, even before the oil was discovered. And we had maritime skills which were needed for offshore activity, especially in the rough waters of the North Sea. And maybe, well, above all, a shared culture and a shared geography between the oil companies and their suppliers. So whatever the explanation, we got this home bias. Then a third thing, Rebecca? The non-oil economy, through this process, became essentially an extended oil supply and service sector. Not all of it, but a very large part of it, maybe as much as half of it. And again, not just oil supply and service narrowly defined, but all the subcontracts and all the other indirect effects, such as hotel services, catering, etc., etc. How would this give a boom? Well, there were limited resources. And since oil companies didn't want to buy from anyone else, then increasing demand made prices and wages rise. Limited resources translates into decreasing returns, especially for management resources, which are definitely limited. One other detail worth mentioning is that all these supplies that the oil companies bought were their expenditures. They are tax deductible, so they didn't go to the government and thereby leaked out to the private sector. So there, I think we have it. And if you read the paper, you can read a simple model that can account for all of this. It's a very simple neoclassical model and nothing mysterious about it. Turns out to be very easy to explain. Rebecca? Now the question, is this Dutch disease? There was no loss of productivity. Perfectly in agreement with Hilde about that, but the price and wage movements were extraordinary. We also had the two effects, Cordonier and Cordon, the spending effect by all means, but also the resource movement effect of how resources were moved from other sectors into catering to the oil and gas companies. So we could explain these all events by the standard neoclassical model. We did not have to to take recourse to monopoly power, for example, on the part of the domestic suppliers. That could have explained it too, but we don't need that explanation. Some might think that union power was behind the wage increases, but no, we don't need that either. It was really, in hindsight, no surprise that this happened. It was the effect of, one, the oil and gas investment boom, two, the home bias, and three, the decreasing returns and limited domestic resources. That did it. Rebecca? Then at the end. The question is, can the good times last? Hilde said a lot about the public sector and how Norwegian politicians have gotten used to being able to spend lots of money. Here's another question being asked by this graph, namely how wages and productivity have moved in a way where we may want to ask, can this last? When we talk about real wages, we can do it two ways. One is the so-called consumption wage, which we mostly hear about, which is nominal wage divided by the consumer price index, the cost of living. The other one is the real wage, the way that the employers see it. Then you divide by the product prices, and that is the one that by neoclassical theory should match physical productivity, and lo and behold, it does. But the consumption wage is much higher because output prices have risen so much more than consumer prices. That will, in all probability, not continue once the oil and gas era is over. It's not over yet, and right now it's going really full steam, as you all know. But Norwegian wage earners have gotten used to very high wages relative to their cost of living. And if product prices don't follow that same path as it has, then something will have to give. Either wages will have to come down, or unemployment will have to suffer, or employment will have to suffer. And there the question comes, was this Dutch disease after all? Maybe I should add, what we did get, that was that very typical effect of Dutch disease, namely real appreciation of the exchange rate. That's what you see in this diagram, essentially. So productivity is not our problem, it seems at least. But I should add about that too, that the productivity that has been gained in the oil and gas industry and in catering to the oil and gas industry would have to be transferred or translated into other types of activity, and time will show whether that can succeed. That's all I have. And then I leave the word to Klaus Bohn, who's professor of petroleum economics and director of the University of Stavanger. Klaus?
Thank you very much, Knut, and thanks for having me. It's a pleasure to be here. I'll share my screen in a second here. There we go. Hope you see that. Well, my perspective on this is from the wealth management side, and I just want to show you here what I believe is going on. It's really a conversion from resource wealth below the ground to financial wealth on the government pension fund, commonly named as the oil fund. This process obviously involves investment, as you see at the left-hand side. It involves extraction and it involves accumulation of deposit of cash flows from the oil-related activities, as well as cumulative returns. And this has accumulated now to an oil fund of more than $200,000 per capita in Norway. So obviously, these activities has left us with a capacity for consumption, at least in the public sector, but as Knut alluded to, also in the private sector. The main story is that Norway is sort of a world champion in resource management, and the mainstream elements are sort of the quality of the resource potential, technology development, the politicians and their interests, institutions, regulations, and policies, the fiscal framework with its institutions. We have also had favorable markets, we have to admit, and we have taken a sober approach to revenue management, as exemplified by the fiscal policy rule and the oil fund mechanism. But as you should suspect by now, there's a crack in everything. That's how the lights gets in, and I also suspect that there are things going on here which should be of concern. Just briefly to the theory, Dutch disease involves real appreciation and erosion of cost competitiveness, normally sorted in the resource movement effect and the spending effect. But I also wonder whether there could be wealth effects involved, or at least a wealth channel for spending effects, and that's what I want to come back to later. In the longer term, theory involves the resource curves that Hilde explained to us due to lacks in learning by doing. Could also be hesitation in policy reforms and rent-seeking activities. And I also believe that the period of the boom could sort of hide some of the most important challenges, and they will loom once the petroleum extraction activities sort of level off and start deteriorating or the downward trend. And that period is approaching for Norway. Probably during the 20s, we will see a downward trend, first in investment and later on also in production. The channel for wealth effects could obviously be due to oil-related asset price inflation in stock markets and in housing prices. And these could both produce wealth effect in private consumption, which sort of link oil-related activities and potentially also oil-related shocks to private domestic consumption. But I've also been wondering about the old theorem of Ricardian equivalence, because if you want to insulate the economy from Dutch disease effects, you need a separation between accrual of oil-related income and their spending. But forward-looking consumers would look through this. They would see that if the government saves, I can spend more. And so there could be a substitution potentially between saving in the private sector and saving in the government sector. I tested this using annual data in an energy policy paper some years ago and found only a muted response in private saving rates or household saving rates to changes in the government saving rates. 0.2 was the long-term coefficient. So I started to look for more, what you would say, sophisticated channels, and there could be a link, I suspected, via housing markets, because we all know that housing prices are fueled by household debt, and if household debt responds to government saving, that could provide a link between shocks to the oil funds, which could produce an increase in household credit, which again could produce an increase in domestic housing prices. So I collected, just a couple of illustrations first. you see on the left-hand side here, household debt and government wealth. Government wealth corresponds roughly to the oil fund development, and household debt is all debt that is taken by Norwegian households. And you see the development in levels in the left-hand chart, and the development in annual changes in the right-hand chart. And there seems to be some sort of connection here. We go on to examine the connection between housing prices and household debt. And again, we see traces of a correlation here, both in levels and in changes. But we need more sophisticated tools. So we went on to specify a model consisting of 7 variables within a framework of co-integration. Finding support for 3 co-integrating vectors, we specified the model in terms of housing prices, household debt, and housing capital stock, as you see here. And what we are looking for is the influence of capital G here, which is government financial wealth, on household debt, and then the influence on household debt on housing prices. We estimated the following long-term equations in this framework, and what you should note here is perhaps in particular these 2 coefficients, because what these tell us is that a 1% increase in government financial wealth would produce a 0.7% increase in household debt. So indeed, a significant part, if you believe this, of household saving is substituted into debt formation in the household sector. Moreover, we find that Norwegian housing prices responds by 0.71% to an increase in household debt by 1 percentage point. Combining these 2 efficients, it means that the doubling of the oil fund would produce a 50% increase in housing prices, with a combined elasticity, as you see, of 0.5. I offer a couple of simulations to illustrate this, and the first one, if we focus on the right-hand side, illustrates the response to a change in government financial wealth, or the oil fund, of 1%. On the household debt level. And as you see, this approaches in the longer term 0.7. We go on to illustrate the impact of a change in government financial wealth by 1% on the housing price level. And the right-hand chart here, you see that that will sort of accumulate to a change of roughly 0.5%, with a slight overshooting pattern in the short to medium term. So this, to me, it seems that it could be a wealth channel where we could sort of look for channels of oil-related shocks and into the domestic economy, and this would imply that the Norwegian approach is sort of leaking, and that we don't succeed in safeguarding this separation between accrual and spending of all oil-related income. My colleagues here have pointed at some challenges going forward, and I quite agree that we are sort of approaching a crossroads here. And my general take here is that the factors that have spurred both revenues, prices, productivities over the last 30, 40, 50 years cannot be expected to prevail, and that suggests to me that some sort of normalization will take place going forward, whereby our productivity levels and our GDP per capita levels will approach those of our neighbor countries. And that would necessarily imply a period where we grow somewhat slower than the historical rates, and also somewhat slower than our neighboring countries. I think this is putting the story of my two colleagues here in slightly other words. What we have been concerned about, and most of the research on the area has been concerned about, is how the macroeconomy is influenced by oil and other resource-related activities during the period of a boom. But what about after the boom? After the oil extraction is sort of oil, after we're out of oil, after we're out of the renewable resources, being gold or coal or diamonds or whatever. So I looked up a few references on that area, and they don't paint a very optimistic picture, because over the longer term, these studies seem to suggest that resource-rich regions, once they run out of resources, they tend to perform pretty bad compared to the neighboring regions or communities or countries. And some studies suggest that they had been better off not finding these resources after all. So that's pretty disturbing to going forward. I believe that the Norwegian economy is well equipped to handle also the reversion process. But I also think that we have challenges which sort of will come to the surface once the good times are behind us. And on that note, I'll leave the word to Knut Anton to head up the Q&A session. So please, Knut Anton.
Thank you, Klaus. We have one question that's been posed already. I'll read it out loud and attempt a short reply, and then I'll leave it to Hilde and Klaus to add anything if they have anything. And even more importantly, I'd like to invite everybody else who'd like to raise a question to pose it in writing in the Q&A feature that we have here on Zoom. The question that has come in says, it's somewhat long, but I'll read it out loud. Would you comment on the challenges ahead for Norway and the world where the oil sector is disappearing and heavy and power-intensive industries such as aluminum are facing a reservation price with the new export cables of electricity? Is there anything left except exports of natural resources such as hydroelectric electricity and salmon? Question mark. Okay, my own answer is, first of all, that I think Klaus in particular has offered some thoughts on it already. But my own answer is what is left. I think this formulation has come from someone at Statistics Norway. Unfortunately, I don't remember who right now, but we will leave off our work, our labor. That is what people around the globe mainly do. Natural resources are to be found. They are sometimes important, but it's not the case that it's the natural resource-rich economies that necessarily become the richest. The Japan, with its long boom during the post-war period, as an obvious counterexample. I would also say most of the rest of Europe is an excellent counterexample, even most of North America. The challenge for Norway going forward is to be able to get to work and do excellent work in other industries than the ones that are related to oil and gas, and I might add also related to cheap electricity. As for the salmon, well, the government introduced a new tax regime today that will definitely eat into their profitability in the form of a new resource tax. Okay, Hilde and Klaus, do you want to add anything?
Just quickly, so yeah, it's a great question, because it's one which we don't have the answer to, but like the literature which Klaus was pointing to, I'm not so optimistic. But I think my in addition to what I agree obviously with what Knut was saying, but what I think I will add is that yes, we will live with each other in the sense the work we are doing, but I think that it's important that, and that's also behind the finding I have, that it's not just that we discovered and extracted oil and gave it to the government, but there's a lot of technology and skills in that process, and that technology, skills, human capital is in the workforce. So what's really important then is that eventually, because it's not happening tomorrow, but eventually, as there will be less investment and production, that we have a good transition to other industries. And I believe that will happen, but I think the issue obviously will be wages again, as Knut also pointed to in his talk. And I think also the issue which Klaus talked about, the wealth, is going to be a challenge for us, because we are not only do we live of the oil fund, but Norway has a higher debt. So households' debt level as a share of income is also record high historically, and also higher than most other countries. I think most OECD countries. So we are quite vulnerable for a downturn in a sense. So that could, if all of this happen at the same time, then it's going to be a bit challenging. But I tend to be optimistic with regard to the technology and human capital.
If I may add, as I see it from an industry perspective, the oil industry faces headwinds from two angles. The first in resource scarcity, because our Norwegian continental shelf is maturing and the discoveries are more rare, and there are not that much oil and gas left out there to be developed. So that's one challenge. And that would sort of vote for stagnation on some point, and that point is approaching. The second headwind is from the climate challenge and climate policies. We have a discussion going on in Norway on whether oil policies should be influenced by climate issues, and that's hardly been the case so far, but I think it will matter more going forward. And the first thing that I think we'll have to sort of give is exploration, and in particular in frontier areas and in Arctic waters, because those projects have very long leads, and if you give out licenses today, that could produce new oil fields in, let's say, 10-15 years. And I think that would be pretty controversial in the climate perspective if you pursue that kind of policies at the same time as you commit to a zero emission society by 2050. Well, on the what should we live off, I just to remind you, we still have the oil fund, and I agree that we have to get used to a situation whereby spending can't increase that much year by year. But successfully managed, there will be $30 to $40 billion every year or so that could be spent on imports without labor. So that could provide some comfort at least. Thank you.
A second question just came up. I didn't mention the name of the person who posed the first question, so let me do that now. Jonas S. Hansen was that question. The second one, I hope I can pronounce it with at least some approximation. Mateusz Kędzierski, or Kędzierski, maybe. Norwegian companies, leading by Equinor, invest large amounts in the wind energy sector as part of a portfolio diversification. Do you think that geothermy can be another part of Norwegian investment portfolio due to the technology and project management common ground with the oil and gas industry? Geothermy, Klaus, can you take up that ball?
I used to work with Equinor, 10 years ago, and this idea came up from time to time, but even then it was not commercially interesting enough. So I don't think this will matter at a large scale in Norway. And the reason, if I recollect correctly, is that our onshore underground, does not have the properties to extract the amounts of energy that would make this profitable. You could do it quite successfully in countries like Iceland and other parts of the world, and we could extend our technologies and drilling capabilities to those parts of the world, but I don't think that will be a big industry in Norway.
I have nothing to add on that.
Yeah, I don't think I had anything to add either. Do we have any more questions? If not, we have also reached the top of the hour, and I'd like to thank my co-panel participants for doing their part in their presentations and in the Q&A part. And also to the IAEE and Rebecca for making this possible to us, and to all of those of you who listened in and peeked at us. It's been very interesting, very rewarding for us to be able to share our thoughts with all of you. Thank you very much.
IAEE wishes to thank our distinguished panelists for an outstanding webinar. This webinar will be available on IAEE's website for future downloads. If you're not a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I officially close this webinar.